Good day, ladies and gentlemen. My name is Sergey Mashenko. I'm a CFA charter holder, and today on behalf of Trendy Pips, I will introduce you to the MACD technical indicator. The MACD is what you see in front of you underneath the Euro-USD daily price chart. It's an indicator, a way to represent the patterns in the market movements in a certain manner. The MACD is comprised of two moving averages, a slow one and a fast one. The blue one is the fast one, of course, and the yellow one is the slow one. The blue one is more responsive to what the price is doing right now, and the yellow one is more smoothed out. It more so remembers where the price came from. And if there is a certain abrupt change, if the price has been going down for a while, but suddenly has started moving up, you will have something known as a cross. It's when, in this instance, the blue line is crossing the yellow line, and the environment or the price direction is changing. Now, the MACD is also comprised of the histogram, and that is simply just the difference between the two moving averages. So the distance between the blue line and the yellow line is the size of the histogram, and that really just shows us, how far out is the price, has the price stretched, and is the stretching subsiding, right? Has the price moved up too much, and if so, did it start moving down? Did the motion up, is it slowing? Is it not moving up as fast anymore? Which is an indication of a certain change in environment that will happen. That is basically what the MACD does. Now, there are a few key concepts behind the MACD that everyone should be familiar with if you'd like to profit in the currencies and stock markets. The first one of these concepts is the idea of momentum. Momentum has been very well documented in scientific literature. It's the idea that people like to crowd in and out of things, be it real estate, art, fashion, countries even, in case of migration, and movies, basically anything, any human endeavor. There are things in fashion and out of fashion that people like to invade with their dollars and drive up its price. So momentum basically says that if the price has been going up for a while, it will likely keep going up some more. So we see that in late September of 2018, the price started going down. Price of euro in relation to the US dollar started going down, and it kept this downwards direction kept going for over 2 months. After this environment of price declines came an environment of a ranging environment with a clear support and resistance levels and about a 250 pip up and down motion for almost 2 months. Now, what this shows us is that there is a certain continuity in prices. Prices like to keep doing what they have been doing until that environment shifts. Kind of like gears in a car, just not as abruptly, but still quite distinctly. So after this ranging environment that ended in mid-January, for the next half a year you have this quite clear declining channel of prices that oscillate up and down with a certain downwards motion overall. And it's quite clear that this pattern, this environment is persistent over time. This price direction is persistent over time. and that is the idea, the concept of momentum. Okay, this concept of continuity, and MACD is trying to capture this concept and trying to take advantage of it by formulating signals of when should we sell and when should we buy. These signals are, of course, formulated by the crossing of the moving averages and the changing of directions of the histogram. In case of a ranging environment, of course, I would use the histogram as it's more sensitive to direction change. So when the histogram starts receding back, well, you see the price moving up, and when the histogram starts receding down, the price moves down. Now, the second concept behind the MACD is that environments shift, kind of like gears. And the MACD attempts to show this shifting, first of all, by the crossing of the moving averages. Second of all, by the shifting of the histogram from, let's say, green to red when the environment was ranging from November to January 2018, 2019. Histogram was largely green. And when it shifted abruptly, well, the environment shifted. So the MACD attempted to show us that there is a change. It's not always as pretty as in this example, even though I didn't specifically pick it for any reason. Sometimes the markets just look ugly, choppy, and with abrupt volatile movements. In those types of environments, the MACD will do a poor job, and most traders will do a poor job as well, because the predictability is just down, momentum is down, volatility is up. In those types of environments, it's very hard to trade. But in these smooth, predictable environments with a distinct momentum effect, where the prices drag down for a while or drag sideways for a while, we can definitely trade, and we can definitely use the MACD. A third concept that the MACD represents is the idea that environments, although they do shift kind of like gears in a car, that a downward motion environment shifts to something else and then shifts to another downward moving environment. In between the shifts, there's a certain slowing down. Okay, so for instance, in this environment between September and November of 2018, we see price declines, and we also see that the histogram, the red histogram, has been tightening as this downwards environment has been unfolding. So what this tells us is that price declines are slowing down, that the price is still moving down, but not as fast, and not in as much as not in such a convinced way as it has, which points to the fact that the environment will soon be shifting. Now, if the price drops were speeding up, if the price was moving down faster and faster, well, we wouldn't know what to say. It would seem that this environment is, will keep going. But if price declines are slowing down, it's pointing to a change that may come. So these are the key points, key concepts. Momentum, that prices like to keep doing what they have been doing. The notion of environments, that sometimes you're in a sideways environment, sometimes you're declining or in a growing environment. And the idea that these environments shift almost abruptly with some slowing down or speeding up or some kind of change that hints to us that the environment will soon shift. Now, the MACD attempts to represent these shifts by crossing of the moving averages. So, for instance, when the blue line crosses the yellow line, this points to us that the upwards trajectory environment has ended, and now we're going to be looking at something else. It could be a sideways environment. In this case, it was a downwards environment, but it will be something else. When in 6th of November, MACD crossed up, the declining environment almost ended. There was still another burst up, down, but largely the environment has shifted to a sideways ranging environment. Now, it would be a mistake for you to simply turn on the MACD indicator and take these signals at face value and simply trade according to what the MACD says. You really need to fit the indicator to the environment you're in. The MACD comes with certain parameters, 12.26.9 in this case. Actually, 12.26.9 is traditional. That's the default parameters for the MACD. But you should always try to see if different numbers would fit your environment better, if they would better describe, predict the price motions. Okay, so for instance, when in the beginning of the year price started vibrating and moving down, we would be best to pick a MACD parameters that really fit with this cycle of up and down motion. Now, in our case, actually, the traditional 12.26.9 parameters fit quite well. If we go by the shifting of the histogram from red to green, so when light red shifts to dark red, we come to an inflection point, and price starts moving up. And when the light green shifts to dark green, it seems to be going down. And this effect is quite stable over the 6 months. So in this case scenario, the traditional 12.26.9 fit quite well. But in other cases it may not. You'd be best to play around with it. Now keep in mind, of course, that trading the markets is a human game, and if traditional MACD parameters are 12.26.9, you should always take a look and see what the traditional parameters are showing you, because that's what a lot of people are looking at and a lot of people are trading by. But you should always try to see if you can program better parameters that fit this distinct environment better.